Bitcoin is close to its all-time high. And the question is there still enough upside potential? What could drive the price higher? Let's have a look at the data most people are not considering. Now, the first reason for Bitcoin's long-term appreciation is adoption. And we see this adoption now through the Bitcoin ETFs. So this wiggly black line, that's the Bitcoin price. The chart starts in January 2024. And this thicker line here at the top, that's how much Bitcoin is held by the ETFs. Now, I like this chart a lot because it shows that over time, the ETFs tend to just buy and hold. They tend to accumulate. The price is going up and down. Yes, the adoption by Wall Street does not stop. The average Bitcoin ETF investor had a very good experience with their investment. And because of that initial positive experience, there's likely going to be continued buying. Now, what we see here in pink, that's the ETF cost basis. So the average ETF investor bought Bitcoin for 75K. If you're dollar cost averaging into the asset, if you're buying a little bit every month, and this is what the AUM chart is somewhat implying, then you're likely going to continue doing this. Bitcoin appreciated more than any other major asset class in the last 1.5 years. So the average cost basis is 75K. And interestingly enough, the average cost basis by MicroStrategy that also buys regularly into Bitcoin is very close to that. It's at 70K. Now, both the ETF holder and MicroStrategy are very happy right now. The overall market is much more in profit though. So when we look at all of the Bitcoin that has ever moved, that average cost basis, that realized price is currently at 47K. Unfortunately, the volatility in Bitcoin can sometimes be larger than most people expect. The price tends to hover around that realized price. Now, I'm not saying that we're going to hit 47K anytime soon, but it's always important to manage risk. So that could either be by setting stop losses, so have somewhat of an active trading strategy, alternatively, simply not allocating too much to the asset class and still have, say, stocks and gold and property at the same time. Now, the ETF flows truly matter. What we see over here is a correlation plot. On the y-axis, we've got the 7-day price performance of Bitcoin. And on the x-axis, we've got the 7-day ETF flows. When money is flowing into Bitcoin through the ETFs, the Bitcoin price tends to go up. When money is flowing out of the ETFs, which doesn't happen too often, but we did have our occasional slight drops in the Bitcoin balance, then the price also tends to go down. Now, this is a 7-day average. On the very short term, it's actually the futures market that dictates the price. Now, futures are levered bets on the price. We're not buying Bitcoin directly on the spot market. We are just betting on the price. We can do this with leverage by depositing some collateral. So if you're trading very short term, the futures is a more efficient way to bet on the price. And when we look at the trading volume over time, it's really the futures that push prices up and down in the short term. So the futures are in bright orange, and compare this to the spot trading volume. It's much, much smaller. And compare this to the ETF trading volume. It's even smaller than that. So the reason why the Bitcoin price correlates that much with the ETF flows, even though relatively speaking, the ETF flows are that small, is because directionally, the ETFs tend to accumulate and the futures just very short term invest and then sell again. Most of the time, futures bet on rising prices. That's why the funding rates are positive. So the longs have to pay the shorts to get more exposure. When the shorts have to pay the longs, then the majority of the market is currently betting on falling prices. And that's usually when things turn around again, because long term, it doesn't make sense that Bitcoin falls against fiat currency, right? Because it's much less expanding in quantity over time. And so when we look at the long term again, right, there are all these different stories. There is the ETF purchases, there is MicroStrategy that buys into Bitcoin. How large are those demand drivers actually, relatively speaking? Will this actually long-term push up the price? And if yes, by how much? Have a look at this. The ETF demand is in green and the MicroStrategy demand is in purple. So those are stacked charts. There was a brief period where the ETFs sold, potentially for tax harvesting. But in general, as we've already established at the beginning of the video, the ETFs tend to buy up more and more of the supply. And so it appears as if most times the ETFs matter more than MicroStrategy. Yes, there had been a massive buying spree in December of last year, close to the price top. But in general, the ETFs support the price more long term. Now, when the ETF demand is that constant, and when the demand is also larger on average than the demand by MicroStrategy, why do we sometimes see those price declines? Why did we go from 72K all the way to 50K while the ETFs bought? Or why did we go from above 100K all the way to 75K, where most of the time the ETFs bought? The answer is the long-term holders sold. So here's the long-term holder supply change. When this is going down, then the people with this lower realized price, with the average cost basis being 47K, they are taking profit. This happened now twice at 72K and at around 100K. Currently, the long-term holders are not selling, despite the price being comparatively high again. And so long-term, we see accumulation by the ETFs and by MicroStrategy. But medium-term, sometimes the long-term holders are rebalancing their portfolio, they take profit, and that then temporarily depresses the price. Now, long-term holders in this chart just means wallets that have held Bitcoin for at least half a year. And this tends to create the acceleration of bull markets, but also the declines. Now, we saw roughly 20 percentage points of Bitcoin move during the 2018 crash, when the price itself went down by 80%. This then puts into perspective how much the price can further rise. Now have a look at this. This is now different Bitcoin treasury companies plus the ETF. It took 3 to 4 years for those entities to accumulate 1 million Bitcoin, or 5% of the supply. It then just took another single year to accumulate another million. So it seems like the accumulation by those entities is accelerating, despite the price having increased massively during that time as well. The price made a 6 to 7x, yet the accumulation accelerated further. And so 1 million Bitcoin, that's 5% of the supply. That in relation to the 25 to 30% of supply that moved hands during the bear market. And that was an 80% drop. That means if you turn this around, right, an 80% drop with the recovery means a 5x. We could come up with a target if the current accumulation persists, if you continue to see buying of 1 million Bitcoin per year, we'd have a target of 500,000 per Bitcoin in the next 5 years. I really like this chart because it shows us just how constant the accumulation is. Over time, we don't see selling of those entities, and that makes Bitcoin supply more and more scarce. Yes, there are new coins that get issued via the miners, but that's less than 1% per year. And again, 5% per year is currently getting accumulated just by those entities. Currently, Bitcoin has a hard time going above 111, 112K. But I think that's 100% psychological. As more money flows into the asset class, this long-term resistance will get broken. Here is what I mean. This is a long-term Bitcoin chart. So it starts in 2010. And when we look at this curved line, so there's nothing scientific about this, just coincidentally, the bull market tops all aligned on this particular resistance. We are very, very close again. And I think we've seen this rejection recently just because of this line. I think just enough people are looking at something like this. And the market can work like a self-fulfilling prophecy. If enough people think that Bitcoin is expensive at that price, then enough people sell and not so many people buy. But what's important to know that long term, the demand is not anymore by retail, it's by the professional investor. And they don't care about those lines. They just continue accumulating, and this will push up the price further. Now here's something very important to understand. Crypto is highly correlated, as in when the market tends to go down, everything goes down at the same time. There's very little variation. This is true for the bear case, but it's also true for the bull case, as in most things go up at the same time. There seems to be not so much benefit in diversification, as in it seems to not really matter what kind of token we buy. If we have 5 tokens or we've got 20 tokens, the portfolio tends to move in the same direction anyway. Now the reason for those synchronized ups and downs in the market cannot just be money flows, because the money is flowing in and out of the overall space relatively consistently with little volatility. What we've got over here is the stable coin market cap. And since October of 2023, we tend to go up. over time. So there is money getting into the system. People deposit their fiat currency, say on a centralized exchange. The centralized exchange then sends it over to a stablecoin custodian. The custodian holds the funds in a bank account and then mints the stablecoins on the chain. And we can see that minting, but also the redemption on this chart. So the volatility that all prices go up or all prices go down, it's not caused by money flowing in and out of the system as a whole. Instead, I believe it's caused by the swapping activity. So people going risk on or going risk off. So it's not the market as a whole expanding or contracting, it's the participants within the market that swap. And we can see that swapping activity with much more volatility here. So this is now the stablecoin dominance. We're not looking at the stablecoin market cap, we're looking at the stablecoin dominance. How much of all of crypto is in stables? And in the last 1.5 years, this tended to move in a range between 9% and 5%. And now compare that stablecoin dominance with the Bitcoin price. When the stablecoin dominance is low, it means the Bitcoin price tends to be high. When the stablecoin dominance is high, it means the Bitcoin price tends to be low. So there is somewhat of an inverse correlation. When people deploy their stablecoins and when they're swapping from risk off to risk on, when stablecoin dominance goes down, prices tend to go up. And so because of that overall effect of market synchronization, because of the high correlation, things move in the same direction at the same time, it's not a good idea to just look at US dollar prices in order to make a good decision whether or not to buy or sell an altcoin. Because charts like this are also influenced by the overall market swapping activity, not just by the swapping activity within the altcoin. So for example, this here, right? This is Dogecoin. And who would have thought that Dogecoin already peaks at 46 cents when in the past it peaked at 56, 57 cents? Who would have already anticipated the peak earlier? How could we figure that out? Here is how we can figure that out. This is Dogecoin's dominance. And here those two tops align very nicely. And so a dominance chart is simply a chart that looks at the current market cap of an altcoin relative to all of crypto. So that way we remove the ups and downs of Bitcoin or of Ethereum. We're just looking at the relative performance of the altcoin versus the rest of the market. And again, that tends to trade in ranges. And that's how we can find out how the second peak should actually happen earlier in US dollars, because the dominance was already at historical heights. But check out this, right? This is Shiba Inu in US dollars. But here's Shiba Inu's dominance. So we do have a quiet, constant trend. Over time, Shiba Inu tends to underperform the rest of the market, and when we are high on the trading range, it might make sense to bet on falling prices. When we are low, we could potentially buy, but of course it's always somewhat risky to buy low when the overall trend is also bearish. So I personally prefer, when there's a declining trend, to look for short opportunities, so to bet on falling prices when we are high, and when we are in an upwards trend, to buy the dips. So when we are in a bull market, we buy the dips. When we are in a bear market, we short the top. And so Shiba Inu underperforms the market over the long term. So instead of trying to fish for bottoms here, isn't it better to just wait for the next short squeeze, to wait for the next rally in the price, to then bet on falling prices? Then the time is also on our side. Even if we see a bit of a spike above the regular trading range, we can just wait it out, because the overall trend is in our favor. That's not necessarily true when we buy, right? When we buy low in a declining trend, we might not find the exit on time and then have to sell again, potentially lower. Another example, here's Chainlink. And what we see over here, that's Chainlink's dominance. So just according to this chart, it might make sense to potentially buy some Link over just Bitcoin or Ethereum. Historically, it's rather cheap. Now, there are two central reasons why I like those relative valuation charts and those dominance charts. The first one is that we can actually see what happens specifically with that token, completely independent of the overall market. But the second reason is by plotting relative valuation charts, so say cryptocurrency A versus cryptocurrency B, we tend to see less volatility. We tend to see the trends clearer. For example, over here, this is the Ethereum price in US dollars since February of 2021. There's no clear trend. It's not necessarily easy to figure out when to buy or when to sell. But then we've got here Ethereum relative to Balancer. I like to look at this chart because it gives us two nice points. First of all, the overall volatility is rather small, but secondly, the gains are also extremely consistent. So this is an outperformance of 5,400%. This is how much Ethereum outperformed Balancer. And again, relatively speaking, with not that much volatility. Getting that much performance in a such consistent manner without having to time the market actively, that's quite unique, right? This is a risk to reward that we can only get with relative valuation plays. We can't get this just by buying something in US dollars. And again, the reason why everything in US dollars fluctuates so much is because the market as a whole goes risk on and risk off all the time. And that creates massive additional volatility. But we can get rid of that volatility. We can actually make money by buying this. Now, we don't just buy this, we have to set up a long Ethereum and a short Balancer position. So to get this performance, we have to do a bit of quote unquote financial trickery. But yeah, why do we see such consistent outperformance? The reason is that Balancer over time tends to have an expanding token supply. And a lot of that additional supply goes to liquidity mining. So to a lot of people that just get continued allocation to the token that then sell it off over time. And so this then differentiates the winners from the losers long term. The people that are willing to take one step further, they're going to look not just at the next 100x meme coin, it's likely going to go to zero, but that actually figure out what are the dynamics within the market and how can we profit from those dynamics. Those people tend to do better than just the people that buy and hold Bitcoin, for example. I have made dedicated tutorial videos on the topic. First of all, how do we even plot those relative valuation charts? How can we look at them? There's an entire tutorial section just on how to use TradingView in a proper manner and seeing the things that most people don't, right? Most people just look at things like this. This is not giving us any edge. But then there are also videos on how to actually execute those trades. How can we gain from relative valuations? How can we set this up? How can we continually make money with comparatively little risk? Now, most people here on YouTube are not willing to share their own performance, but I'm okay with doing that. I'm okay to share how much money I'm making on average over buying and holding Bitcoin. Because this is again where the big differentiator is. Everybody can get Bitcoin's performance, but actually the art in this is to make more than Bitcoin. If we take the time to trade actively, we have to outperform the benchmark. Now here are the monthly returns that I have made over buying and holding Bitcoin. So every data point is a month. This dotted line here is the 12-month moving average. And when we average out all of those dots, the monthly alpha over buying and holding Bitcoin for me is 2.1%. Now that might not sound like much, but that compounds over time. And then especially if we also add more money in the portfolio over time, we dollar cost average in, we have a quite nice smooth growth curve. So here's my active portfolio with trading and dollar cost averaging. And I hope that over the next 2 to 2.5 years, I'll be able again to double that portfolio. If we of course use leverage, we can make much more on a single trade. But I'm super cautious. I take very small bets. For example, have a look at this. I'm sharing my own trades. This is in the Gerhard Trade channel, and I opened again, based on relative valuations, a short of the Donald Trump meme coin. Trump relative to Solana was quite high, and it started to come down. And then our members also entered. They also had some leverage in there, so this was some gains. I waited a bit longer, closed this then at 141%. But because I only use 1 or 2% of my entire portfolio on a trade like this, the average alpha per month is only 2.1%. But if you're willing to take on more risk, you can of course grow much faster. Actually, our members do exactly that. So here's the channel, share your wins with some leverage and proper market timing and still reasonable risk management. There are several 100% in single trades easily possible. And so I think it's very important to forget about price targets, as in can Ethereum hit $4,000 or can Dogecoin hit $1, etc. Those kind of things don't really matter. What really matters is the relative performance. Capital within crypto moves from asset to asset. Attention moves from asset to asset. So there is all of the capital in the space. Sometimes it is risk on, sometimes it is risk off. But what really matters is where is the capital flowing to and where is it going away. And then all we need to do is to trade the relative valuation. It's much easier to make money that way. Again, would you rather hold this or would you rather hold this? And so yeah, feel free to check it out. It's currently $125 per month. You are locking in that rate. So when we come back to the 165 again in a few months, then you will still continue paying the 125. Whatever you're paying now, you will continue to pay. I will not increase the rate for everybody that's signing up now. If it's your first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in premium. There should be also somewhere a pop-up here on the right where you can click directly. It will lead you to the website. So see you over there. Cheers.